Hi, and welcome to today's webinar. My name is Hodan Omar, and I'm a policy analyst here at ITIF and the Center for Data Innovation. I'm very happy to be hosting this webinar on whether the United States needs a digital dollar. Here at the ITIF, we, like many of you who are joining us here today, have been looking at the impacts and implications that the pandemic has had on our economy. Many individuals, institutions, governments, and their policies have really been challenged during this time and been brought under scrutiny. So we've been thinking about what policymakers need to do to steer innovation, not only to kind of remedy any negative economic impacts, but also to think about how we can bolster resilience so that we can be ready for any future shocks. And one of the proposals that has come forward is that of digital dollar or a digital cash. There's actually long been a call for the abolishment of cash, but that's been made even louder by COVID-19. Partly because people have been concerned that cash is a carrier of disease, but also because people have been worried about how they're able to access much needed payments at this time. And I think for today's discussion, it's important to delineate between the three main types of digital money that exist. First, there are the kind of community-based cryptocurrencies, of which Bitcoin is the largest and most well-known. But there are also corporate currencies, like, for example, Facebook's Libra project. And there's a third category, which is what we're talking about today, which is central bank digital currencies. These are state-based fiat currencies like the dollar or the euro. So they're very different to what we've seen traditionally. China has already steamed ahead with the development of their own digital yuan. So there's a case to be made that the United States needs its own dollar, digital dollar. And we've got three great panelists here today to discuss this. Joining us locally here from the United States, we've got Daniel Gorfine. Daniel is the co-founder of the Digital Dollar Project, which has really been leading the conversation here in the United States. He's also the CEO and founder of fintech company Gattaca Horizons, and he was also previously the Chief Innovation Officer at the US Commodity Futures Trading Commission. Then joining us from my own hometown, London, we've got Garrick Heilman. Garrick is bringing both an academic and an industry perspective to this conversation, as he's not only the head of research at blockchain.com, but he's also a researcher at the Center for Macroeconomics at the London School of Economics. And then joining us from India, we've got Tanvi Ratna. Tanvi is the CEO of think tank and advisory firm Policy 4.0. And she's previously worked on Capitol Hill and with Indian Prime Minister Modi. So a really great panel, and we're really grateful that you're joining us from many different time zones. So I think to start things off and get started on the right foot, it would be good, Daniel, if you could clarify exactly what we mean when we say digital dollar, and how does this differ from the ways in which fiat currencies are already digitized, and what are the benefits that it might bring?
Sure, great. Thank you so much. And it's great to be on with all the other distinguished panelists, and thank those of you who are joining virtually to watch us today. So it's a good kickoff question because there are many technology-enabled and electronic means of payments that already exist today, and many of them are quite fit for purpose. When we're talking about a digital dollar, at least from the Digital Dollar Project perspective, it means a few key things. The first element is that we're talking about tokenized money. So this means effectively creating a bearer instrument whose properties suffice to demonstrate ownership over that asset and allows you to actually transfer that asset. If you think about it, physical cash is a token. It's a representation of a claim on a central bank liability. And so what we're effectively arguing for here is digitizing and tokenizing a dollar in the digital world. The second factor is that a digital dollar, at least according to the Digital Dollar Project, would be issued by the Federal Reserve System and would accordingly enjoy the full faith and credit of the US government. So this would effectively represent a third format of central bank money, along with banknotes or cash and reserves. Finally, the Digital Dollar Project is advocating that this type of tokenized money be distributed through the existing two-tier banking system, which would include banks and regulated money transmitters. So I think it's important to level set there that when we talk about this, it's tokenization versus accounts-based systems, which typically rely on messaging in terms of transfer and still require an account holder or manager to effectuate the payments mechanism. So those are some of the key distinctions when we talk about a digital dollar.
I would also add in here, on top of what Daniel said, I think this is a great point on which to clarify some misconceptions people have. A lot of money that circulates now in digital form, it's mostly credit, like it's not currency, right? It's not a legal tender. So if you have your money in a bank account, that's mostly bank credit, right? Whereas if you have natively digital money, so you have a natively digital like $10 note, that is a very different relationship now that you have legally with that currency. And that has a lot of implications in terms of how money supply is managed, how the banking system is managed, how the whole credit-based, economic policy that we have in the world today, how that is managed. So it's very different from other forms of digital money.
Thanks very much. And just to add, for all those watching at home, if you have questions for our panelists, if you're joining from the Center for Data Innovation website, you can go on Slido. There's a link to Slido where you can submit your questions. And if you're joining us from YouTube, you can go to the event description and there should be a link to where you can submit your questions. So Garrick, what do you make of the form that has come in the legislation for the digital dollar, especially with regard to it being Fed accounts versus what Daniel has proposed in the digital dollar project?
Right. Yeah, this is, I think, a great topic and starts to take us more into the weeds of the design of digital dollars. I think there are some real interesting elements to what's been proposed in legislation, some positives and some trade-offs. The proposals you mentioned would leverage kind of the existing Federal Reserve accounts-based system, which commercial banks, and other kind of official institutions have access to, some foreign central banks and other parties, but not something that everyday citizens like ourselves can access. And really just extending that system to everyday citizens in various ways. The banking system would still be involved, and also the postal system is part of the proposal to kind of extend access to parts of the country where that are underbanked. I think there's some real pragmatic and interesting sides to this proposal. Like, we have existing infrastructure. We don't need to kind of invent new technology necessarily, something that's been proven that works. We just have to kind of scale it up. I think that's one interesting side to this. But I also have some concerns, and there's a number of concerns that could be raised. Privacy is not something that gets a lot of attention, I think, around the existing legislation. I think it's kind of assumed away that this isn't something that's a priority, and or we're only going to protect privacy for very, very tiny amounts of money. I think that might defeat or undermine some of the objectives around trying to bring some of the underbanked or unbanked people into the digital economy. I'm not sure that the proponents of this legislation fully understand all the reasons and complexities around why people, sometimes of their own volition, do not have a bank account. It's a choice, not necessarily something they're always denied. And I think more effort needs to be put into the privacy question, especially if you want to get the percentage of people who are unbanked reduced from around roughly 7% of Americans, shockingly high number, to a lower number. And that could have huge implications for things like, for example, the stimulus checks that have gone out recently. The cost of distributing checks or debit cards, the time it takes, the fact that some people don't have a physical address or moved, like students. These are all real kind of selling points for why a digital currency and widely accessed digital kind of distribution mechanism, I think, could be a real value add. So the conversation is really timely. The other thing too, that around the using the Federal Reserve existing system, the Fed Now proposal that's been embraced to kind of have a faster payments type system finally in the United States. That's going to take 4 to 5 years to roll out for various reasons. And I think I think we should ask ourselves, with especially COVID-19 and this crisis, can we afford to have a similar kind of timetable for making something happen? And would that be kind of the realistic timetable for doing something like extending the Fed account system? That's another important angle to this. But there's a whole lot more that I could go on about, so I'll stop there and we can go in different directions based on what's of interest.
Tanvi or Daniel, do you have any comments on privacy in terms of whether it's sort of inimical to civil liberties, and in particular, it's a sphere, right? Because above certain, even with cash, above certain amounts, it's not like, you know, if you're spending tens of thousands, that's not kind of tracked, or that the banks won't report that.
Yeah, I'm make a quick comment about privacy, and then I want to kind of come back to some of the comments I think that Garrick shared, because I think that they're on point. I mean, when it comes to privacy, the beauty of the technology around a tokenized dollar is that a lot of these questions become design choices, right? Like there are different ways that you can construct the system and construct rights and access that would kind of calibrate along a spectrum of privacy. At the end of the day, these are going to be policy choices that need to be made. And I think different CBDC projects around the world, different legal systems, economies, will approach those issues from a different perspective. You know, obviously from a US perspective, we have a long history of essentially protection around privacy, especially constitutionally enshrined in terms of what the government can have access to and when. So I think that those design considerations will be part of the privacy debate in the United States. If you are analogizing this to cash, you can certainly look at the existing kind of KYC AML regime around cash, think about whether there are certain dollar amounts that make sense to be kind of changing or calibrating a little bit the privacy expectations when you're using a digital dollar. Now, of course, because of the facility of use of a digitized dollar versus cash, we may need to think about what those right dollar thresholds might be. But I just want to come back to some of the proposals that have been kicked around recently on the digital dollar. And of course, like nomenclature and definitions matter. I mean, again, there's a lot of different ideas around how you could improve payments. You know, I would say that this crisis that we're currently in, it has certainly, and rightfully so, underscored what Garrick was getting at, which is, are there better ways for us to target and move money, move funds than what we currently do today? You know, from a digital dollar project perspective, we would caution that while the crisis might be the right reason to really start exploring and thinking and piloting around these efforts, it's probably not the right time to try to implement some type of broad-based project. There are too many design considerations, implications that need to be considered. I would also just highlight, as a kind of a side note, that one thing that I think we've learned through this current process in the US is that digital identity is actually one of the fundamental questions and problems that we're trying to navigate, is identifying who the end user is on the other side who's trying to receive money. If we had information about identity, then existing payment mechanisms could deploy emergency relief pretty quickly. All of that being said, back to the point of the crisis kind of underscoring the need to explore better architecture, better designs, more targeted infrastructure, that's the right takeaway. And I do think that hopefully coming out of this period, there will be increased impetus to really explore and pilot application of a tokenized dollar.
Thanks. One question that we had from Slido related to design is, if the digital dollar is a token, is blockchain technology a requirement? Tanvi, do you have any thoughts on this?
Yeah, I mean, I did want to comment. I can comment on this as well as some of the earlier points. So I'm glad that Daniel brought up digital identity, because you know, I was thinking of design in this sense, like in terms of the layers that come in when you think of a digital dollar. I'm sorry about that. I'm an engineer previously, so this is the way I think about design. But the digital identity piece, right? And that's a very relevant question for us in India. So we have one of the largest digital identity programs in the world. It's about 1.2 billion uniquely identified citizens. And this program itself has faced legal log jams because of privacy. It is still, for example, not a mandatory program for government schemes because of legal concerns. But I think, you know, going back to even what Garrick was saying earlier, a lot of the design choices you make, they're sort of the last leg of thinking about the digital currency. The first of it is just for what purpose you're creating it, right? So, for example, you see countries like China, India, which have very robust digital payment systems, have a lot of instant payment, settlement, different solutions for it. And it's working pretty fine today. But these countries you see are already sort of moving ahead in thinking about a CBDC. So their aims are not necessarily payment related, right? Their policy goals are not payment related. And that cascades down into the design choices they make on this currency. So I think also in terms of what the Slido question was, do you need blockchain for a tokenized currency? I mean, we've seen countries doing without it, like the Chinese yuan that we see now. It's not a blockchain-based design, though they have a blockchain services network. But for a lot of pilots that are going around in the world, I think there's about 80 of them. A lot of them are very DLT-based or blockchain-based from what we're seeing.
And I'll just come in briefly on the tokenization and blockchain technology question. You know, it just those are two terms that have to be very carefully defined, and they're two you know, terms that oftentimes get jumbled up and confused. You know, what is tokenization? Well, we go way back. You know, I studied economic history. You can think about some of the early versions of kind of paper representing gold and evolved during against the gold standards, an early form of tokenization. You're not transferring gold, physical gold, because that's really cumbersome and inconvenient. You've kind of tokenized it by having paper represent it, right? That didn't involve blockchain technology. But then it gets into what is blockchain technology, and we spent a lot of time in some of the research publications I've done, the Cambridge blockchain benchmarking study from a few years ago, laying out in, you know, somewhat excruciating detail kind of, you know, what is distributed ledger technology, what is blockchain technology, what are distributed databases, and how do these things all differ. So I think it's really important when we use terms like this, and Daniel mentioned this earlier, we really carefully define precisely what we're talking about. A token, a digital token, could, you know, be managed on a centralized database system. It doesn't have to be, you know, managed with a distributed, you know, blockchain type system, to be sure.
And if I could just add, at least from a digital dollar perspective, I completely agree. And that you do need to separate the two. You know, one is the tokenized asset. The other is effectively the rails or the system you use to move that asset. The digital dollar project is kind of deploying a champion model where we're saying that the rails should likely be DLT based. And we're thinking that as our champion model because of privacy implications and because of resiliency implications. You know, to the point that Garrett just made about central databases, the truth is a massive centralized database may be the most efficient mechanism for moving any kind of asset or tracking the movement of any asset. But there are trade-offs that come with that, including the idea that you do have a central party in that instance that manages and oversees all payment data and information. So whether that's a public sector actor or a private actor, there may be some concerns around that, as well as the resiliency component. You know, today with the way we're moving, do you want to have effectively all eggs in one basket is one way to put it. So there may be some benefits as we develop the technology that kind of helps build resiliency and redundancy into a payment system. So, you know, we'll continue to pursue this champion challenger model where we have our thesis as to what would be the best kind of future-proof model. But also consider whether there are other challenger models that could be more effective in actually solving for what you're trying to solve for. I think Tanvi made that point at the outset, which is exactly right. You know, you don't just build things for the sake of building them. You have to have an idea of what problem you're trying to solve for. But again, a lot of work and a lot of testing needs to be done before we're sure whether DLT-based or inspired systems can scale and provide the purported benefits that we think they can.
Great. And sorry, Tanvi, did you have something to say?
Yeah, I also wanted to add on the point of trade-off. So, you know, thinking of blockchain versus other technologies, definitely that is one design trade-off that you make. But there are so many existential trade-offs you have to make when you're thinking of the CBDC. So there's a real threat of cannibalization, right? Because you have now, if, for example, one of the legislation's proposal was about having a wallet with the Fed, right? Citizens have a direct wallet with the Federal Reserve, and what would that do to bank deposits, for example? Right? Like if you can deposit your money with the central bank, then why would you put your money in a bank? Because it's so much safer for you to keep it with the Fed. And then what does that mean for credit in the economy? What does that mean for lending? What does that mean for the way we make economic policy, which is all our monetary policy is credit based, right, in the world? So I mean, there are some real risks here, and so it's very interesting that Daniel and their project has from the start looked at this two-tier sort of system, wholesale sort of system, but that's not necessarily going to be the case for every country, right? Because there are some studies, I think like Bank of Canada had some interesting studies where they're talking about how you can use these properties and increase competitiveness in your financial system, in your banking system. So I think you'll see some very interesting design choices by different countries. You'll see a lot of interesting trade-offs between what the existing monetary system is, existing monetary policy is, versus what it could be with a CBDC.
On this point, we have a question from Jonathan on Slido. What regulations or amendments would need to be made to the Federal Reserve Act or other laws to allow for digital currency?
So that's a great question. And look, our early understanding is that just as the Fed has the authority to mint and print, coins or cash today, they would have the same authority to mint and tokenize the dollar. So if you just think of this as, again, you're mirroring in a digital world what we already do in the analog world, we think that they would have that authority. Of course, that's something that will need to be further explored. And a project of this scale and magnitude is going to require kind of broad-based buy-in, whether that's from the entire public sector and government and policymakers on Capitol Hill to the private sector as well. So I also just wanted to quickly come back to what Tanvi was saying about the two-tiered banking system and the idea of Fed accounts, and just underscore that, yes, I think that's completely right. It's a pretty revolutionary and radical idea to go direct and have the Fed serving in a retail banking function. And there are a lot of economic considerations that I think are tied to that type of decision, which is why we think it's a far more practical and probably better from just an innovation perspective to have this deploy through the two-tier banking system, through existing banks and regulated money transmitters. And just quickly on this point, I think part of the allure of the Fed accounts is the idea of access and inclusion. But one of the, again, kind of theses or hypothesis that we're putting forward is the idea that a digital wallet, even if maintained by the private sector, is almost like a bank light type mechanism. It's focused exclusively on custody. And as a result, there may be kind of economic efficiency in providing digital wallet services. And the regulatory touch on that could be lighter than what you expect with a traditional bank account. If those things are true, it may be more economically viable to offer kind of digital wallet custody services to a broader set of or underbanked Americans than we currently do today with bank accounts. So I think that's the access and inclusion argument, and something that needs to be tested. To the extent that that doesn't fill all gaps, there may be public sector solutions that can fill existing gaps. But to start, you would kind of build this around the existing system and infrastructure, and also just test the idea that this could become more ubiquitous for in terms of access. You can imagine like smartphones coming preloaded with a digital wallet that you could activate, and getting into that digital identity layer. I think that coupled with your ability to register a digital wallet would be very interesting.
Another question that we have is that the Constitution prohibits states from issuing currency. Should that be revisited? Should a city or a state take the lead on a US digital currency if the Fed doesn't?
Who wants to tackle that one?
Looks like Garrett, I think you got it.
Political question, boy. So this came, I hail from California. I'm old enough to remember when California had some budget problems before the Facebook IPO and other things that boosted California tax revenue. There was talk, I think there even may have been some form of a script that may have been floated for a little while in California. these are obviously complicated issues, and they're real political issues. States, it's argued are sovereign, within, kind of the U.S. federal framework, and so, boy, I can't really, I will say that I think it's very interesting to run pilots when you can, A/B testing. There's been a lot of talk around central bank digital currency that this would probably take off first, not in China, not in the United States, but in a Marshall Islands or a Caribbean country, a smaller market that didn't have a systemic kind of position within the global financial system to kind of experiment and see how something like this could work. And it's really interesting to see, China in some ways leading the charge, and the United States now with legislation and this conversation happening. I think, the pressure for the major countries to do something is quite significant in the current environment. I do worry a little bit about, kind of a major country kind of really going first, going far with something as radical as creating an alternative to storing your money in the banking system. I mean, the RICS paper, which is excellent. I really encourage everyone to read the RICS paper, which I think inspired a lot of legislation that's currently under consideration. I'll just quote from it. Insured U.S. retail deposits are very sticky and have proved not to be run prone. I think it's a little dangerous just to kind of look at recent history and say, oh, people would not run to the safety of the Federal Reserve System and digital central bank currency in a crisis. I mean, I think that's wildly optimistic. And when people kind of, I think, really dug into this, the idea that, well, we can just charge a negative interest rate and push that to negative 10% or 20%, drive people out of the Fed account back into the commercial banking system. I mean, we see all the time people willing to take a loss, significant loss, if they know they're going to get something back. And so I would not underestimate the risk of a run. And when you're talking about rolling something this significant out to a country like the United States, I mean, that's a big, big change. We'd love to see all our experimentation, to be honest, for a major country to take a huge radical step.
Yeah, and I'll just add, I do not think that, states or cities or municipalities should be in the business of trying to, essentially tokenize or mint tokenized currencies competitive with the US dollar. I mean, at the end of the day, that's the purview of the Federal Reserve. That being said, I'll make 2 points. One, some of the private sector innovation going on around tokenization and money and payments, that is absolutely not antithetical with our view of CBDC development. And in fact, I think a lot of those developments are encouraging the thinking around CBDC. So back to this idea of pilots, I mean, you're going to see kind of a real world laboratory of private sector and public sector efforts that will keep pushing the thinking. And I also do think that there could be an interesting role for states or more local governments where if you're trying to pilot the benefits of tokenization, you could imagine the tokenizing of things like unemployment benefits. And so that it doesn't have to be the dollar per se right off the bat. You could actually be exploring what happens if you tokenize certain assets, make them available and transferable through digital wallets. Do we get some of those inclusion, efficiency, lower cost benefits that we think we would get? If the answer to that ends up being yes, then I think that just lends even more credibility to the argument, okay, let's go all the way and actually tokenize the dollar itself. So I think that might end up being the role of states and local governments, but I would think it would get quite confusing if you saw, the idea of returning to competitive actual currencies at a public sector level.
Yeah, I did want to comment on what Garrick said about China and a large country undertaking this experiment. I think this is a very interesting experiment, and this is something that we've been studying very closely for some time. And I think China's experiment sort of it just widens the lens with which a country approaches the CBDC, all right? Because it's not really a currency experiment. If you see, they have layered on a three-pronged program, right? So they have the CBDC, they have the blockchain services network, and they have a standards project, all right, which is all going on simultaneously. And they all sort of like stack onto each other. And so China has, their experiment is really about a tech supremacy game, right? And they are sort of really leveraging the whole spectrum of opportunity that blockchain technology offers, right? And this is very interesting because it's sort of um, it elevates the CBDC experiment from just a currency experiment into something linked to future readiness. It's about getting ready for a future where you have a lot of tokenized assets, you have a lot of tokenized contracts, you have a machine to machine communication, you know, you have like borderless communication. And if you don't have a currency that can deal with that sort of an environment, then it doesn't matter. Like even now, if a lot of commodities are denominated in the dollar, right? Tomorrow, if commodities are tokenized and the entire transaction is happening digitally and you don't have a digital equivalent that can survive that sort of an environment, then that's a very big strategic concern. And I think for China, the way they're approaching 5G is, you know, that is very much the approach here. It is very much about tech supremacy. And I think that's a very important, that's another factor that layers on, you know, when you think about a CBDC, when you approach a CBDC, it's not just about money. It's about what you're unlocking for the future.
Yeah, moving to this kind of international perspective, Garrick, do you think there is a strategic risk to the United States not adopting a digital dollar?
I do think, you know, the U.S. dollar, as dominant as it is in as a reserve asset, as the rare and a lot of international trade. You know, a lot of the Chinese Belt and Road Initiative, my understanding, is funded with U.S. dollars, for example. You know, it lives in a competitive environment, and so it has to kind of innovate at some point to keep up, especially with rising economic powers that are you know, seemingly pushing the envelope around innovation, have much more of their economy already digitized. Boy, go to, you know, back when you could go to Beijing, try to pay with cash. You know, it's almost impossible now. You know, so I think there is absolutely that. At the same time, I think one thing the U.S. has to be careful of as the big giant on the international financial landscape is the threat the dollar poses as something of a wrecking ball to local currency autonomy and you know, kind of further dollarization. I mean, right now there's friction, you know, with getting physical dollars and even more so with coins into foreign markets that you know, kind of, you know, limits the degree or speed of dollarization. But you take a, you know, maybe this is a good segue into something like Libra, you know, something that is married with a widely used social network. You know, in a market or country that has a history of financial instability at a time of great financial uncertainty with massive public sector and private sector debts, especially in the emerging markets, boy, the dollar could be quite a wrecking ball potentially around the world in digital form. And it's something that the US, you know, and the Federal Reserve have to take into consideration as they think about, you know, the parameters and how this can be transferred and used. That's another complication around this whole topic.
Yeah, actually, Garrick, I think it's a fascinating topic as well, is that, you know, when we think about all this vis-a-vis other global projects, you know, I prefer to think about the digitized US dollar, not as a defensive measure, but it's something about remaining competitive. It's about future-proofing the role of the dollar. And I'll pause there and say that there are many factors, of course, that drive kind of like the reserve currency status of the US dollar. You've got, you know, rule of law, economic stability, the breadth and depth of the markets for dollars. There are many factors. Sanctions policies do matter as well. At the end of the day, though, technology and friction are one of the factors. And I think that that's what we're actually focused on here. As an interesting kind of historical reference, you know, the US dollar is actually based on the Spanish dollar from a few hundred years ago, which from my understanding was a lighter coin and it was divisible. It was easy to actually cut up effectively. And so that efficiency from a carrying it and using it perspective mattered. It was a good design choice. So I do think in a digital world, if you think about tokenization, does that, you know, decrease friction to use the dollar? The answer is probably yes. It does raise this really interesting international implication, which would be not only is it not defensive, but it's actually an offensive measure, which could make the US dollar even more attractive internationally. What does that mean in terms of increased dollarization? Will other economies and countries be open to accepting that money? Because yes, I agree, it could be a risk to fragile domestic currencies. So that is one of the open questions. But I think, again, there's a lot of benefit that comes from that as well. I mean, if you think about the end user in certain economies, they would have access to a very stable medium of exchange and store of value. And there's a lot of kind of consumer benefit that comes from that. And if the US isn't doing it, there will be other international efforts to offer that type of stable store of value and unit of account and medium of exchange. So it means the US does need to stay forward leaning on this, because it's not as if the world's going to just stop and not move forward with these questions.
And how might a CBDC work alongside, or perhaps not alongside, other forms of digital money, like corporate currencies and community currencies? One of the questions we have is, do central banks see a growing competition from Libra? Is it a key reason for growing talks about CBDC in many countries?
Yeah, one point I just want to make on this question, I think it's an excellent question, is I'm a big believer in redundancy. One of the reasons, and Daniel mentioned this earlier, that blockchain technology, distributed systems are really attractive, is they are very resilient. You have redundancy and backups, and Bitcoin, for example, has been operating basically uninterrupted for over 11 years. That's incredibly important when you're talking about payments and something as important to maintaining social order and economic activity and stability as money and currency and payments. So I think in general, competition is also very healthy from an innovative perspective, but there's also this kind of like, well, what happens if something unforeseen happens and a payment system goes down? Do we have alternatives? People have argued, Ken Rogoff at Harvard, for example, have pushed kind of the let's abolish cash argument pretty far, but even he stopped short of arguing for completely abolishing all coinage. And I think, for me, I'm happy to hear that, because I always think about kind of these doomsday scenarios where solar flares or what have you kind of knock out our electronic means of transacting. What do we do? Having backup systems in place around something that's critical infrastructure like payments and currency, I think is really important. Having multiple payment rails and currencies in the private sector, public sector, I think that's all very positive. How they interplay with each other and what that means for financial stability is another question. Right? You need to kind of bring that perspective into this discussion, but resiliency is a good thing in general.
Yeah, and I would add to that I think we live in a very exciting time where we're seeing the narratives on money getting challenged. I mean, I don't think this has happened at any point in history where there's been so many alternatives of money. So we have like the crypto space, which has its narrative, which is talking about independent money, and then now you have these CBDCs, you have other form factors. So I think it's going to be a competitive space, and it's the next few years we'll see what emerges victorious from that.
Yeah, and look, from my view, I mean, a CBDC should operate alongside existing payment mechanisms and channels. It gives people choice. I mean, we don't think that we should abolish cash. There may be decreased use of cash over time, but this operates alongside that. When you bring up, private sector initiatives, again, this is not antithetical to the development of private sector initiatives. And if we're being totally honest, we're not having this conversation today, but for Bitcoin. I mean, I would argue that, Bitcoin got people thinking about automated systems, more efficient ways to move value and information about value, the idea of tokenization and being able to prove ownership over a unique asset. This is all stemmed out of conversations around Bitcoin. Libra and the idea that you could have 2 billion users, utilizing some type of a new medium of exchange, certainly got people's attention. But CBDC, and at least from a US perspective, if you think about what this represents, it's effectively the infrastructure of the ultimate public good, which is like the US dollar. So you're upgrading the infrastructure of money. Many things can be built on top of that infrastructure. That's how it works today. We have an existing infrastructure of money, and a lot of private sector solutions have developed above, built on top of, or around where there are gaps in that architecture. It's, in fact, I would go a step further when you start thinking about things like stable coins and otherwise. If you digitize the dollar, you can imagine there being kind of a stable coin world built around that just enhances programmability around the dollar itself. So you don't want, the Fed shouldn't be in the position of programming, certain use cases into the dollar itself. But if it is digitized, you can imagine new products that do program smart contracts around dollars, and that could unlock a whole field of innovation. So it should be about confidently operating alongside existing payment infrastructure and architectures and giving people more choice.
Garrick, I know you've done a lot of work with stable coins. For those who are not as well versed, could you explain what a stable coin is and how it really fits into this whole story?
Thank you. Yes, we published a couple major empirical studies in 2018, 2019. You can access for free on the blockchain.com website in the research tab or on my personal website. So basically, in 2014, around thereabouts, the cryptocurrency world developed what we call a stablecoin, and it was basically a way to hedge against the volatility of cryptocurrencies like Bitcoin. Tether being the most famous example, founded in 2014. And the way most of these stablecoins operate is they hold US dollars in a bank account that back a digital token that is programmable and transferable like Bitcoin. Can be used with digital wallets, traded on cryptocurrency exchanges, transferred around the world very quickly and very inexpensively. And we've seen a huge boom in stablecoins this year, by the way. The total market value of all the stablecoins like Tether and USDC coin and others has more than doubled this year, up to over $10 billion. And they're being transacted as much as Bitcoin. So they're really gaining in popularity. We don't have a really great picture always on exactly how they're being used. Or we, for example, one of the questions is, are we seeing more commerce happening with stablecoins rather than using them just to kind of hedge against cryptocurrency volatility in trading markets? That's an open question. But they, in some ways, and this is to Daniel's point earlier, this is where things are already happening. The dollar is already getting digitized by the private sector. There's a huge private dollar market called the euro dollar market that's existed for decades. This will happen in some ways, in one way, shape, or another, whether or not the Fed and the US kind of do something, it seems. And, I think it's a really kind of interesting and exciting kind of development that gives us the opportunity to learn a lot about how digital currency, digital dollars can be used, can be designed. What are their strengths? What are their weaknesses? Can you do things if you want to build compliance, and regulatory kind of features into the protocols themselves? These are all really, really interesting and important questions, and allowing kind of the stablecoin space to kind of, I think, develop, still pretty small, offers, I think, some really kind of interesting petri dish, if you will, for kind of, the US digital dollar debate and design questions.
Thank you. And Tanvi, a question for you from Slido. Can you expand on your point about impact on banks? Isn't the purpose of depositing money in traditional banks to earn interest or other services?
Yes, so from a customer's perspective, that is why you put your money in a bank, right? But from a central bank's perspective, or from a policymaker's perspective, that money that you put into banks is multiplied into credit across the economy, right? And that is pretty much the whole point of monetary policy, and that's the whole point of playing with interest rates, is that you allow more or less credit, and that allows more or less economic activity in the country. So when a central bank, because of its own innovation, sort of kills that capability, then it's a very big dilemma that they have to grapple with. So this is there is not yet a definitive answer on this, on how CBDCs, apart from there are two major models of CBDCs, right? The retail and the wholesale model that are talked about right now. And the wholesale model sort of replicates what's happening now, where a central bank gives money to the banking system, and then the banking system lends to people. And so you just change that money from a paper-based currency to a digital currency, and everything else stays the same. But not every country will go that route, right? So if we see even with the digital yuan, there's some very interesting components of it, which which are targeting real cash usage, right? So people can transfer the digital yuan without even having a bank account, just between two phones, without even having internet, right? So they have built these kind of capabilities where money can move right outside the banking system. So I mean, this whole the kind of functionalities you allow with the CBDC will have real consequences for the banking system in your country.
So, and I want to come back to this. So from a retail perspective, this question around, interest bearing or not is a really, really interesting topic. And so at least if our analogy with physical cash holds, one way to think about this and one way to design this would be that an individual, much like you can go to an ATM today to get cash, would be able to go to your, regulated money transmitter or your bank in order to withdraw effectively from a digital ATM. Now, once you're holding that digitized form of cash, the question becomes, where are you parking it? If you're holding that in a custody wallet, it's better to think of that as similar at that point. Maybe it's managed, maybe it's hosted, but it's like a physical wallet, right? Or it's like a safe deposit box, at which point you're not generating interest on that, and that money is not being lent. So that if you design it that way, then the retail individual, just as today you might want to carry a certain amount of cash around with you to be able to transact, may choose to do that. Of course, if you want to generate interest on your savings, you would frequently move money into your commercial bank account, at which point it's fungible with commercial bank money, and you may be receiving interest-bearing payments through that account. So that's one way you could design the system. And that's probably the closest analogy if you think of this as tokenized physical cash.
There's also been talk of synthetic CBDCs. The IMF have said that perhaps that's a better option than a fully public-focused CBDC. So what exactly is a synthetic CBDC, and how does that kind of play alongside these other options?
Yeah, I was I was in a meeting at the OECD where there was some very heated discussion about this term synthetic CBDC, because many central bankers, get very nervous about something being described as a central bank digital currency, and having that kind of imprimatur of this is, from the central bank attached to something that actually, has a separate system maintained outside the central bank that could have, say, a bug or an error that doesn't map to, say, reserves held at the central bank. I mean, that's the idea that somehow, Libra, for example, or another stablecoin would have maybe reserves held at the central bank. So the ultimate kind of custodian looking after it with real central bank currency, but maintaining kind of a separate database external to the central bank and transactions happening there. What if there's a misalignment? And people come, screaming into the central bank, wait, I thought I had central bank currency and I don't. So there's some controversy around the labeling. Again, this comes up a lot, and it has for years. Definitions, taxonomy, very, very important to be precise and understand what we're calling things, why we're calling it that. But that's kind of basically the idea that the central bank wouldn't necessarily be in the game of fully operating the central bank digital currency. It would delegate that to an institution like a Libra, or another private sector institution that would then in turn keep the reserves. And here in the UK, there's something sort of, it hasn't been launched yet, and there's still some questions about exactly how it's going to be designed, but it's called Utility Settlement Coin, that appears to be, set up similar to that, where, things would be kept at the central bank here at the Bank of England. And Governor Carney, before he left, alluded to that kind of design. And then there would be a private sector consortium, in this case, commercial banks, that would run kind of the system.
We have another question that's come in, which is, do you think the public is ready for a major adoption of a digital dollar? What would happen to the dollar if the digital dollar does not have mass adoption?
So look, I will start off by saying this is why I think, no, the answer is we should not, from a US perspective, be broadly adopting and implementing a tokenized US dollar in the immediate near term. A much more prudent approach is required. The costs of getting this wrong are incredibly high, which is why real world pilots is the way to move forward. And that'll be the next phase, at least from the digital dollar perspective. We'll be putting out a white paper in coming weeks that kind of lays out our current thinking, but we'll also then start moving to the next phase of real world pilots so we can start testing the merits. I think the time for talking about the different iterations and trade-offs, that has been very important. But that time is going to end very soon, where we need to start real world testing so we understand if there's a real there in terms of the different applications, whether it's at the retail level, wholesale, or from an international perspective. Now, as far as adoption, again, if you view this as choice, and if this is operating alongside existent payment mechanisms and central bank monies, then you don't need to see any certain adoption of the digital dollar immediately or for certain purposes. It is infrastructure. It is a public good. It is something that I suspect will get built upon and will provide real benefits in all of those different categories that I just underscored. It'll be in different ways. But it doesn't require kind of mass adoption, because you're not saying we're phasing out cash or we're going to make cash, we're going to ban cash. That's not the objective, at least from our project's perspective.
Yeah, I would add to the previous question that you asked about the synthetic CBDCs, and so I think what is very transformative is that with a CBDC, if you build a CBDC, you are sort of moving into the model of the tech ecosystem where you've sort of built a platform, for example, like an Android platform, and then on top of it, you can start building so many applications, right? So the current fintech ecosystem that's there in the world, it mostly is sort of fixing inefficiencies in the existing architecture of finance. And then when you're changing the fundamentals of that finance, when you're changing the way money is and money works, then you are opening up a whole other realm of opportunity. So, you can think of money more like Android, and the App Store versus like, the way we think about it now, which is just banks and central banks. So when you allow for the sort of a synthetic model, the level of innovation you can bring in is way higher. I mean, you can actually do transformative things with that kind of money, because it is a programmable money. Then that's what's very different about a CBDC versus other digital forms of money, is you can program so much into it. Like you were asking about regulations earlier and how those will change when you have a CBDC, right? So you could actually program regulatory checks into money itself, right? Like there's just a limitless, school of possibilities that open up.
On that point, if you don't mind, I'd love to give people, just building on what Tammy said, was kind of an example of programmability and what it means for you. I think a lot of people can imagine, oh, I get my payments faster and it's cheaper, and that part of it I think is not so difficult for people to grasp around digitization, compared to checks and slower forms of payment and money. But the example I've been using in my teaching for years is, imagine one day in the future we're traveling again, and you buy flight insurance, and you're concerned about cancellation or a health issue, and you have to cover the cost of your flight, or you're concerned about just the flight being disrupted for some reason, in which case you'd be compensated. The exciting thing about programmable currency in this particular case is, in theory, you could, park your digital currency in a smart contract, which is just a computer program that in this case would monitor whether or not a flight is on time or not. A binary outcome, it's either on time or not. And if it's not on time, per the terms of your insurance, the contract would automatically pay you your money. There would be no claims process, no delay, no needing to fill out a form and go through that bureaucratic process that, in the UK, in a previous year, there were some 600,000 people who were eligible for flight insurance and never collected it, maybe because they couldn't be bothered, they forgot they had it, but they didn't collect something that was owed to them. Maybe the insurer went bankrupt, and so that's another kind of exciting element of programmable currency. In this case, you could have kind of interesting, models around how those premiums, those insurance premiums, are custodied. Maybe they sit kind of in the middle of you and the insurance company, and again, if flight's on time, goes to the insurance company. Flights canceled or not on time, it goes to you. But even if the insurance company goes bankrupt, you could still get your funds. And so in some ways your money is kind of protected. And this may not make a lot of sense or seem that important in, countries where there's, good insurance regulation, well-capitalized insurance companies. But in many places around the world, custodians do, go bankrupt. They do run off of the money sometimes. Huge problems around peer-to-peer lending in China, for example, years ago. So that's another kind of exciting kind of trust minimization kind of possibility around programmable currency that goes beyond just, oh, this is faster and cheaper to send and move money around the world.
Thanks. And we've spoken a little bit around the underbanked and access, but there's been a few questions around how a digital dollar, either on a Fed account or a two-tiered banking system, would affect undocumented immigrants. Any thoughts on this?
Yeah, so what was proposed in the RICS paper, and I don't know if the legislation was this specific, is that, there wouldn't be necessarily ID required for low access, access to the Fed account, central bank digital currency. So that was one way to try to get around the kind of, I don't have ID, and there's a lot of people around the world, in the US as well, who don't have, ID or physical address like we talked about. But what's less clear is, like, what kind of information are you going to be asking? Even if you don't require an ID, are you just going to give this to someone who, doesn't want to give you their name, or so there's other ways you can discourage people or scare people away from something, even without requiring an ID. And so I think this is something that really needs to be carefully considered here. That it's easy for people to gloss over things like privacy. Well, of course, the central bank doesn't want to be, running a network that's prone to money laundering, and we're going to really ratchet down, on ID and verification and all these things. But the thing is, as soon as you do that, you go down that path, you do start to drive people away, and sometimes for reasons other than that they're a bad guy, and so there's a similar, problem around security. The more secure often we build systems, the less accessible, the less convenient they are. And so you have to try to find this balance with anything around security, around privacy, that allows you to achieve your goals of increasing financial inclusion and not deterring people from accessing the system.
Thanks very much. And just as we come to the last few minutes of the hour, I have a question that I'd like each of your thoughts on, which is, what feedback have you had from elected officials who are interested in pursuing a central bank digital currency? What is the key to getting other officials to support a digital currency from each of your perspectives in each of your respective countries?
So I'm happy to start. I mean, look, there's a lot of interest in this topic now, and I think it's fortunate that it's bipartisan in the U.S. I think that different stakeholders see different benefits in a CBDC, and certainly the events of the past year, whether it's Libra, talk about the digital yuan, the current COVID crisis, it's kind of thrust a lot of conversation around digital infrastructure. Do we have the best infrastructure in place for money, for payments? So I think it's a very ripe time, and there's certainly a lot of policymaker interest. Now, as far as the question, what's it going to take? This is why I'm a steadfast believer in the idea of actually doing. Again, the Fed is not going to, in my view, I wouldn't expect the Fed to roll out kind of a broad digital dollar in the near future. But the idea of public-private partnerships on pilots so that we can be measured, we can actually understand what outcomes are, We can understand what the risks and challenges are. I think that's the way you bring all people along on that journey to really understand what it is you're doing. Because again, the US should not do this cavalierly. It's why we're against doing anything kind of knee-jerk in the midst of a crisis. But I think that's going to be the way. So again, our next step will be really putting pen to paper, at least in scoping out what pilots can look like in the retail, wholesale, international context. And then we need to do it, and we need to start doing, and we need to be able to measure outcomes and understand benefits and also understand risks and be prepared to be surprised. I would also say that, because I think some of the benefits may not materialize, but there will be other benefits we didn't expect. And I think there will be certain challenges that arise as well that we'll have to confront.
Thanks.
I'm happy to speak next. I think COVID-19 is really, made the case, very strongly that something needs to be done around, upgrading our financial system, its infrastructure and its money, the speed of delivering relief, the efficiency in terms of reducing the cost of delivering it, like we've talked about with postal checks, traveling sometimes overseas. I mean, sending thousands of dollars by check overseas to people, Americans living abroad. Surely there's got to be a better way. And what do you do when you get that check? I mean, not everyone can deposit checks remotely from wherever they happen to be. Financial inclusion, we've talked about that. People who have access to, bank accounts and who have to use like low, high cost check cashing services. I mean, that's, heartbreaking to hear stories about people getting their COVID relief payment and seeing a very substantial portion of that getting, taken away from them. Helping the most vulnerable, people who have relocated recently, students, who don't have an address, people, who are concerned about hygiene and checks and physical currency. These are all things that really make the case for delivering payments digitally in the current crisis, not to mention the geopolitical context. There's other things we haven't even talked about that are very controversial, but are worth at least mentioning, which is the debate around negative interest rates, for example, and how you would implement such a policy. That's happened in other parts of the world, Japan, parts of Europe. Hard to push negative interest rates, potentially hard to push them if people can take their funds out of the bank and put it into cash. Again, I'm not endorsing a policy of negative interest rates, very, very controversial policy, but if that was something that needed to be implemented, digital currency certainly offers an interesting way to support that monetary policy. I think, last year before COVID-19, all I saw were all the reasons for why there was resistance and how this was going to be something that would take a long, long time. I think the political appetite has really changed in the last couple of months and has accelerated something that I think a lot of people feel now is inevitable. It's just a question of how it's designed, how it's rolled out, how it's constructed.
Thank you.
Yeah, and I would say, I mean, this is where you really see the differences in countries sort of come out. I think for a country like ours, where we have, very robust digital identity, digital payments, we've had billions in this COVID move through, rapidly in direct benefit transfer to accounts at the last mile, right? So there has been a lot of push in the last 6 years to set up the traditional banking infrastructure as well as the digital infrastructure. So for us, I mean, the question is more around, well, what's the problem that it will really solve, right? Like, what is the CBDC going to unlock for the economy that, the payments infrastructure, the fintech infrastructure is not solving, right? So what is the sort of leapfrogging effect it will create, right? And then we, of course, have also like neighborhood concerns with, the Chinese project and what that means for our neighborhood. And so I think, the starting points for each country are so different that even the paths they take will end up being very different.
Thank you very much. Thank you to you all. We've actually reached the hour. We didn't have time to get to many of the great questions we had on Slido, but hopefully we'll be able to continue this conversation either offline or on Twitter. And I'd like to just mention that the ITIF have recently launched our new podcast. innovation files, which you can find on any podcasting platform. So if you want to hear more or hear about new and important topics in technology policy, make sure you subscribe. And I'd like to thank you again to all our great panelists and to all of you joining at home. So thank you very much, and we'll speak again soon.